Hey guys, pleasure being here again. And today I'm very, very happy and very privileged to have Oz here. Oz is a very creative person with a very non-trivial story to tell you about how he became to the many he is right now, and I think it's going to be extremely interesting to hear how the evolution of his perspective and his background really evolved into doing some significant operations in the financial markets. And I'm extremely excited, and I'm extremely curious about the conversation today. So without further ado, I'll let my guest to speak up. So Oz, pleasure having you here. I'm very excited. How are you today?
I'm great. Thank you, Afek. Thank you for having me in this podcast. I'm
That's
so
my pleasure,
happy
mate. That's my pleasure.
happy
It's
to
not
tell my
yours, it's
story
mine.
and share my knowledge with you and your
I'm
audience.
I'm very excited as well. Before we're going to be starting, when we have discussed before the podcast, you have shared with me some significant story that you have, how you became to be a fund manager, and how you became to establish a fund, how everything got all started. I think it's a very it's a reliable starting point for our conversation today. What do you think?
Yeah, to start with the background, how I became a fund manager. This is the okay. We can start with that.
If you want,
Yeah,
if
let's
you want.
roll it. So, just to our audience to know, my name is Oz, and I'm living in Tel Aviv. I have my systematic hedge fund named Elevate Algo Fund. And my background is multidisciplinary, you can say. After serving in the army, I enrolled to my bachelor degree in Bar Ilan University. And my initial thought was that learning economic and political science is the best combination for making business and earning money because policy you have everywhere. You have in every place politics and political movements and ideas needs money. So if they control the money, they can change the reality. It's relevant for today. We can see it in the United States, in Europe, in every place. So the combination is pretty. It's a combination of two different skills. One is soft skill, politics, and economics is more realistic. So the combination of the two is a great power. During my studies, I understand that statistics and econometrics is my strongest trait or interest, and I search for how to enrich my knowledge and to be more expert in that domain. So I had master's degree at the same time I had the bachelor's degree. So I had master's degree in math, and I got excellence also in my bachelor's, also in my math degree. During my math studies, I developed few algorithms and I published two papers. The first one was about algo trading. I actually was fascinated that everybody talks about indices and the S&P 500 is the benchmark for everything, and that a lot of fund managers are losing in the long term to S&P 500. So I want to research and understand the fundamentals of the S&P 500, which is we talk about it, that it's algorithmic trading tool. We can talk about even further about that later.
We will, trust me, we will.
So, so I developed algorithm based on physical about based on physics that assume that stock is like an oscillator. You put weight on the oscillator and you see the movement of the oscillator up and down, and you can trade the frequency of that. After this paper, I published a paper about sport gambling. There are cases that you can earn money in gambling strategies if you have submarginal events. for example, if you have a pot that you share with a lot of participants and the pot is increasing from week to week because you don't have the first or second prize spread between all the gamblers. So there are few cases that it's you have a positive expected return if you gamble. So I did it also in sport events and sport betting, and I published article about that. So I understand that I love mathematics, politics, and math. So
That's a
after
hell of
my
a
master,
combination.
yeah, it's a great
That's a hell of a
combination.
combination.
So from that point, I went to Bank Poalim, which is on those days, it was the biggest bank in Israel, to the brain unit, which is kind of the under the radar unit that you develop all the new technologies in the bank. Year later, I transferred to Bank Leumi, to the technology division, and I've been there as a data scientist for 1.5 years. And then I got back to do my PhD in bioengineering. During the period I was a PhD student, I was an advisor to the Bank Leumi for the risk department unit. So they had lots of models that I developed in uh, in my role as a data scientist over there. And they didn't know how to validate and how to respond to my models. So they asked me to be their advisor. So I did it for 2 years. And during that period, when we all suffered from the COVID and their implications of the financial markets. We also crashes on March and April in 2020. And nonetheless, I traded my own principle by myself with my algorithms that I developed during the years. So a lot of people ask me to run their money.
Mhm.
This is the starting point of my real venture as a asset manager. One customer today, she's a customer, but a few years ago, she was kind of a client that called me and asked, "Oh, can you run my money? I need someone to help me to invest it because I'm just losing money on the COVID." So after a few sessions that I refused to take her money, she sent me an agreement that the lawyer created for her, which details all my responsibilities and also my compensation if I run her money. And she told me that I can run this money, I can run uh, her account and invest for her, and it's totally legal, and I can do it up to 5 clients. So there is no regulatory issue in that case.
Mhm.
So I accept her money and I ran it for 1 year. And that year, she also introduced me to her friend, which introduced me to another friend, and it can accelerate.
That's
And
how you
it's,
grew. That's
yeah,
exactly how you grew.
and it's accumulated to 5 investors, which is the limit in Israel to run investors' money with no licensing. And the next step was to creating my own fund. So during my PhD, I started the process of opening a systematic hedge fund. And now we're talking, the fund was initiated in 2023. And since inception till now, we have 2.5 wonderful years. We have a year with a war in Israel, and then we had 2024, which was a very great year for all markets. And 2025, we have Trump with his tariffs, and now we have Venezuela under Trump administration, and we have lots of good things in in the future.
Everybody has their own roller coaster in the markets, obviously.
Yeah.
And I think it makes the job way more exciting and way more enthusiastically driven for those who are really driven like driven to do that type of work, and it actually look, if we have force hypothetically, and like the Trump administration is like, it's like a fire who actually will actually gets fire among all the trees together, and it actually washes away all the miners and all the small and all the weakest trees, and it only keeps the strongest one. So as long as you thrive during the Trump administration and all the adventures that he plans for us in the White House and everything. So I think, or I assume, you might be successful even in the next administration, minister administration in the United States. So without further ado, I would like to jump over to your first paper that you have published recently, that you have published when you were doing your master's, about the oscillator and about U.S. equities being an oscillator to a benchmark. I would like to explore a little bit more about like the abstract math that you take that you took. What was your assumptions? What actually the assumptions right after the paper? How you actually designed taking the S&P which is like the world's most known benchmark, and how you actually um, move the needle from the S&P itself to having a much more in-depth overview of how we're supposed to actually take or approach it in different ways.
Mhm. So thank you for that question. I prefer to talk about methodology over is yeah. So let's talk about methodology. So first of all, as you said, the most known benchmark or the most known index worldwide is the S&P 500, which describes the biggest companies worldwide and specifically in the United States. And I wonder first why it's so good. Secondly, what's the best benchmark, and then to understand the benchmark fundamentals and how to overcome or how to exploit the inefficiencies in the S&P 500. So first of all, as you said, the S&P 500 kind of winning most of hedge funds in the long term. If we can see, according to Spiva, 87% of the hedge funds wins the S&P 500 in their first year. Then it decreased to around 67% of the hedge funds win it for the first 3 years. And if we go to 5 years or 10 years, we can see a very heavy decline. And on the long term, over 20 years, we can see only 5 to 6% from the hedge fund have an excess return over the S&P 500 that choose the S&P as their index, as their benchmark. So what is very interesting to understand that most of the funds that we're talking on, there are funds that invest in fundamentals or growth or something like that, are reading papers, reading about the stocks, talking with the managers, with the workers, and so on. And then they invest by financial ratios and their own practices. But eventually, 95% of these hedge funds are losing to a very simple algorithm that trade the S&P 500. So
Mhm.
if I understand correctly, 95% of hedge funds are losing to a simple algo trade formula. And the formula is as
That's a
simple
very
as
rough.
that.
That's a very rough assumption to make. Like
Yeah.
I know that you're not the one who really put the assumption to the breed in the world, but 95% of all hedge funds are actually losing to the S&P by their by but over the course of their lifetimes, I think. So what's so if that's a problem that you're actually highlighting, how you're going to be actually taking that and breaking down into the methodology of knowing what really happened when they have started, and 87% succeeded to exceed the S&P yields, and over and over and over over the years. how you actually map the successful hedge fund to the non-successful hedge funds using the methodology of benchmarking to the S&P.
It's a big question, but we can break it to small questions. First, what is interesting is
You do
that
you.
yeah, is that most hedge funds are not systematic or algorithmic at all, and their benchmark is algorithmic trading pattern. So it's very interesting because if you are talking about investment and you tell someone I'm using algorithm to trade or systematic trading approach, it's very weird. Even though that most of the passive investors we call are using algorithmic trading. So first of all, algorithmic trading is pretty usual. Most people using algo trading instruments and tools to invest their money and do not have any question about that. So first of all, as I mentioned, my fund is systematic. It's fully algo trading fund. So the first approach is that algo trading and simple algo can win most of the times, can win and exceed higher returns than most of the hedge funds. But I want to clarify more about the S&P 500. 500 are not exactly 500. So if we're talking about S&P, currently now they have a bit more than 500 stocks inside, more than 500 companies. And 2 quarters ago, it was 504 companies. And not all top 500 companies are really inside the S&P 500 because you have also politics inside of that. So there are big companies are not really members of the S&P 500 index because of politics of the S&P 500. So we see again, we have the economical view and we have the political view. So politics we can even find it in passive algo trading tools. And the S&P 500, even though you built from top 500 companies, they have a few more mechanisms. The first mechanism is rebalancing. They have max cap or max weight for each stock, but each stock has its own weight by its own weight in this capital market. So we see the capital market of each company and
Hmm.
how much it's from the total market cap of all S&P 500, and we assign the same weight to these companies. So we see that we have rebalancing mechanism every 3 months. And last thing, it's kind of a Darwinism that the winner survivors, the companies that still increasing their value stays inside S&P 500. So we see it's kind of the winners become stay winners and the loser go out of the index. But this is based on the rebalancing and the size of the S&P 500. So we have rebalancing on every quarter. So we have this mechanism operated 4 times a year. And after understanding that we have the filtration or the decision how many stocks to use is 500, and we choose the biggest companies in the S&P 500. Now we need to understand if we can unlock and make a better algorithm that can also tackle prices when the market is going down or breaking, how we can handle it. And also, if we can change the freshness of the data. I mean, do we need to do rebalancing every month, every year, every 2 years, every day? Or if we need to update the index every 2 days, every week, or every month. For example, the S&P 500, we refresh the 500 stocks every quarter with the rebalancing mechanism. But we don't have to do it at the same time. We can do to check every month which is the top 500 stocks, and then to put money in the stock that now ranked in top 500 or now.
Yeah, I'm with you.
Therefore, talking the S&P 500, we need to be more specific and talk about the mechanism of the S&P 500. So basically, we have 500 stocks, and these 500 stocks based on their market cap. We're choosing the highest market cap in the United States stock exchange. And this is the filtration criteria. It means this is the universe that we're working. We can buy only these stocks. Now, what is the weight of each stock? Each stock is the ratio of their market cap versus the total market cap of the 500 biggest stock in the S&P 500. And then we have the rebalance. We have rebalancing mechanism every quarter. So I
Mhm.
start to understand that we have all these features or all these criteria, but we don't have limitations about the risk size. So we don't have any risk management mechanism. We're always 100% investing in the market cap, in the 500 stocks. We cannot decrease or increase our cash in this methodology. And if we have crashes, we cannot use any mechanism of hedging. Means no shorting, no using options, nothing. And this is a very simple and at the same time very sophisticated mechanism to invest. As we all know, keys keep it simple, stupid. And this is the idea that helps the S&P to work pretty good and wins most of the time a lot of very great fund managers. So understanding that, I start to asking myself, do we need the top 500 or can we choose less than 500 stocks? So I took the top 50, top 100, top 200, and top 300, and this is the results over time versus the S&P 500. So we could clearly see that the top 50 stocks overperformed during a lot of period on the top S&P 500. And this is because the top 50 has the highest weight inside the 500 stocks. And I understand the mechanism
Responsible for
that,
most of the variance. That makes
yeah,
sense. That makes sense. If we're speaking about that direction of research in that direction of methodology, that's exactly the equivalent or the exact meaning of the Pareto rule. The Pareto rule, the 80-20, 20%, 20% of the stocks in the S&P 500 are actually responsible for 80% of its variance. Uh,
exactly,
and and and
Pareto
and
mechanism, yeah.
conversely, and that's a very interesting assumption. By the way, look, I'm doing podcasts for a year and a half now, and I have never had a chance to speak with someone who actually really challenge himself to see how the assets inside of the S&P would actually behave if he will excluding some or including others to make sure that he will be able to yield higher yield rates in the future. So I think it's a very creative standpoint of building a methodology to actually tackle the S&P.
Yeah, we come from the research in the university. So first we need to understand the mechanism and then to unlock it. So as we talked about it, the if we choose less stocks and with the higher cap, we see higher returns over time. And now I understand also the mechanism because if stock was performing so good, it will increase its market cap over time and then it go higher and higher in the rank and it could reach to the top 50. But if stock is underperforming over time, it takes a lot of time to go out and go down over the 500 to be ranked 500 and above, for example, to get to number 600 in the overall stock market. So because we have this mechanism of good stocks going up and bad stocks going down, 500 stocks is too much of companies in an index to make such a high return over time. So most of the stocks, as you said before, are not responsible to the total return of the index, only 20% of them. So we can choose less than 500 stocks. This is the first step that I fully understand because we don't need hundreds of positions. We can also be satisfied with only eight. This is the extreme case when you choose eight companies from eight different sectors. It's give you a better diversification and higher returns over time Then
Better
trading,
diversification
yeah,
instead of 50. Yeah, well, that's pure statistics.
yeah, pure
Like
statistics.
t
Yeah, yeah.
taking A stocks in comparison to 100 stocks, like the variance is well
Yeah,
distributed around
right.
all the 100 assets, and A stocks make sense.
So if you choose eight stocks from different sectors, you can create less correlation between the stocks, and then the volatility is lower, and you can never know which sector will rise this year. Previous year it was the chip stocks or AI stocks, and now it's going to be the energy ones because this is the pipe of the AI, right? Everybody now needs energy and runs after energy. So you can never know who will be the best winner. Maybe now the gas and the oil because Trump intruded to Venezuela. You don't know which sector, so you need always to be covered in a few sectors. And this is the first understanding that I had that you don't need hundreds of positions. You just need to understand that you need diversification, which you can find it statistically with.
Diversification in sorry to interrupt you,
Yeah.
but I have a question. When you're using the word diversification, what are you referring to? Are you referring to I don't know, different diversification types in between the positions that you're holding, or different diversification in between obviously between the asset types and the asset classes or the asset universes that you're actually having positioned that you're actually having position
So
inside, or
it's a great question because you can assume that in few sectors you have a different correlation, but in aspects of time lapse, you can find that sectors can build and vanishing correlations between them. So you need always to check the metrics of correlation between the assets that you trade. You can assume you have, according to, you have more than 12 sectors. So you need to choose. I'll talk about how to choose the first and second and third stocks in a few minutes. But the understanding that you can choose eight stocks, it's good enough. Of course, I have more than eight positions in my fund, but this is the minimal number that you need. So you don't need to use hundreds of positions or thousands of positions to create an alternative return to S&P and to win the S&P 500. This is the first thing. The second thing was to check the rebalancing and the updating of the index itself. The index, you check every quarter, you check which are the top 500 stocks. If one of the stocks get lower rank,
each quarter based on their most recent market cap.
yeah,
You have just a question as a data scientist, you have like no importance to previous data or previous enrichment points that you can actually gather in order to approximate the I don't know the top tier stocks that you would like to hold.
of course you can know, and this is how people and funds can exploit this irregularity because when stock go out or in the index, you have a volume that increase in one day, right? From selling or buying. So you can go inside the position a few days ago. If it's long, if this stock is going inside the S&P 500, and you know that someone needs to buy it, for example, the ETFs,
Mhm.
so you can buy it and just go along with the volume spike and sell it on the day of the index updating. So you can create tiny returns from these irregularities. But this is a specific trick for traders, not for a value investor. And this is why hedge funds can create alpha on tiny events or irregularities over time. So you can exploit the time over time over time. Also, the stocks are going out. You can short, and the stocks are going inside the index. You can go long a few days before the index will update. So the rebalancing mechanism is interesting because every quarter you have it. But what happens if we will do it not every quarter, but once a year or
Yeah,
once every 2 years? What will be the returns of the S&P 500? Yeah, yeah.
just for clarification, your balancing mechanism that we're speaking about is a static algorithm. It never moves. Like you have like a static understanding of the mechanism itself, and it never actually changes its parameters or I don't know. Like the mechanism remains the same mechanism.
And the S&P 500, yeah, it's the same
All
one.
right, all right.
Every
Because
quarter, if
that might
they,
if we're going to be changing the mechanism, that might impact the entire theory.
yeah,
All right.
right.
Now it's totally understandable. Yeah, I'm with you.
So the rebalancing view is every quarter we adjust the weight for each stock according to their market cap. And I ask myself, what happens if we don't do any update and not do any rebalancing at all? We can do it once a year, every two, or 1 in 2 years, or 1 in 10 years. So the longer time period where we check, we saw that the return declines. Declines one
The
in
return of the
10,
stock, the return of the group of stocks.
yeah, of the S&P
What are you
500.
referring
If we,
to?
yeah, of the S&P 500, for example, if we
Hmm.
use, instead of rebalancing every month or every quarter, we just do it one time in the 10 year. Okay. So now, the last time, for example, we had it in 2010, then we're doing it in 2020, and next time 2030 would be the update of the index. So what we see, there is a diminishing return, and why is that? Because strong companies that grew over time, you don't give them more weight, they still remain very small in their percentage. And big stocks that
Hmm.
are underperforming, putting a lot of weight and carrying down the returns over time. So the balancing mechanism is very important, and also the freshness of data or the update of the indices itself. And then I checked what happened if we make it not every quarter, but every 2 months, every month, every week, and every day. So we saw that we can increase the returns if we do the rebalancing and updating the index every month. But if we're going to do it every week or every day, we're losing money because the commission that we'll pay for buying and selling all the stocks and rebalancing it will cost more than the returns over time. So there is a sweet spot of number of stocks, there is a sweet spot of the rebalancing mechanism and updating the index itself. And now we're talking about the limitations of managing the cash. The S&P 500 is,
Can I stop you? Can I stop you
yeah.
before moving on to the next topic of the methodology? You have spoken about the mechanism itself. I would like to learn from you how you are actually crafting the mechanism that you would like to apply to that uh, that we would like to actually apply basically. How would you actually craft a mechanism? How do you actually build it? How do you actually make sure that, like, in terms of actually locating the local minima of sweet spots that you're actually looking for is actually gonna apply consistently and will not will not lay you down like in terms of the construction of the entire mechanism itself.
So now I'm talking how I
How the
make
mechanism itself is supposed to be crafted.
of the S&P 500 that they suggested, or
Again?
the mechanism in the article, or the mechanism that, can you reply it again?
Yeah, the mechanism itself, the
Yeah.
mechanism in the article or the mechanism that you're actually applying nowadays. How do you actually craft that particular mechanism? What are the ideas? What are the inspirations? How do you actually think of a reliable mechanism that you're able to actually apply onto different types of market universes or different types of market assets? So you would be able to actually make sure that we will not neglect each other once you're going to production.
Okay, so before that, we need to talk about the second article, and then it will can clarify the whole system of my
I go with you.
mechanism. But before that, let's finish that. We can see if we will sum it up. First of all, there is the universe that you need to understand that you need to trade. You can't trade all stocks in the universe. You need to choose the how many stocks or how many positions you need to trade in each time. What's inside your universe, the top 100, the second 200. What are your stocks? What are your positions? Are you trading commodities, the US stock, Europe, and so forth? After that, you need to understand that you have the weighting mechanism, the rebalancing mechanism, and what the frequencies that you are updating the list of your stocks or your positions. After understanding that, and also I'll talk about that you need always to save some cash for opportunities, we can speak about my second paper and then to understand the whole perspective and the whole mechanisms that I crafted to create my own strategies and my own fund. My
Good.
second paper was about sport gambling. In Israel, we have a game named Winner 16 or Winner 16. It's you choose
To be frank, I have never participated in that game, to be frank with you. Just for you to know, every time that I go to the grocery store, I just purchase my own, and I would never, I always skip over it. But I see among tons of financial people and fund managers that I know personally, they're extremely passionate about sports gambling, like in terms of trying to predict or estimate what will happen in the next NBA game, or what will happen in the next NFL or Premier League or whatever league that you might like. It's a very interesting topic. So let's do a step before even. What actually catched you in order to go narrowly focus over the over sports gambling even before you have started to work on the research itself?
okay, so first of all, I'm not a gambler, I'm an investor. And this is
No,
the
obviously,
yeah, this
obviously.
is the pinpoint that I want to emphasize. In sport, you can be a gambler and you can be an investor. You transition from gambler to investor when you have an edge and you understand the risk, because gambling it's putting money without assessing the risk of the the returns that you can expect. And if you know what is the expected return, and then you have adjusted risk. And then if you understand that you are not gambling because for example, you love the Miami Heat or the Bulls or somebody else in the NBA, you are putting money to create money.
That's a gold jacket, by the way. If you say that, yeah, that's a very rough one to say.
Yeah. So if you doing your bets according to your risk assessment, in that point you transition from a gambler to investor. In and you have few games or few gambling paradigms that you can create kind of a profitable gambling mechanism. And this is when you have prizes that accumulate from week to week if you don't have the biggest winner. For example, in Winner 16, you have five prizes. The biggest prize, if you strike all right, you have 16 games, so you need to mark all of them right. You have the opportunity to do so. It's 3 in power of 16, which is more than 70 million possibilities. It's very, very low. But if you manage to do so, you will win the big prize. In some cases, every 4 to 5 months, you can accumulate enough money that is right for you. The expectancy of return is higher than the purchase that you will do in that game. So you statistically have the arbitrage to gamble, and this is why it's interesting, because in this type of prizes, you can create money by gambling on teams that you don't even know the game. It could be on tennis, it could be on basketball. It's really irrelevant to the ratios. You're just in the model to understand, is it a home win? Will it be a away or a draw? You just need to make a prediction and then to
Mhm.
accumulate all the predictions and create RQ models that model everything together and give you the percentage if you will make money or not. So the mechanism was that I need to understand if I can make money in Winner 16 or not. And the first stage is to create a model that will let me know if I have the opportunity to create money or not. So each week, the model will tell you as an investor or a gambler,
As a meta model, like
yeah,
as a meta model,
yeah,
really? All
that
right.
go and gamble or don't, or go or no go. Go, it's go and gamble, and no go, it's stay with your cash and wait for that, for opportunity. And the week it said, okay, go gamble. Then it tells you also how many tickets to fill in, because if you send one ticket, your probability to win is almost zero. So you need to fill 1,000 tickets, 10,000, or 100 tickets, 100,000 tickets. So the model will tell you, okay, for this week you need to fill 1,000 tickets. Okay, and
Hmm.
now you have over 70 million. So you need to choose 1,000 over all this universe of tickets. So you need a ranking mechanism that rank what is the best ticket to send and which is the least one. So you'll take the top 1,000 tickets in the ranking mechanism. Then you fill it, you pay the price for sending them, and then you um, showing the prices with all the other gamblers. So I showed that this strategy can create money. The IRR or the Kaggle or the interest over years, it's around 3.2% a year. So it's very, very low. And the drawdowns are awful because you have weeks that you have no price at all. So the returns are zero. And this is why you can't put all your money in one time when you're gambling. You need to have kind of a stomach. So you use percentage of how much money you have in each week until you have the opportunity to win the big pot. And then it's kind of returns you all your losses and you can see a positive return. So what was interesting is to understand risk management, because risk management, here you losing everything or see partial of your money or seeing your money or over much more. So here the risk
Hmm.
management is much more crucial than the stock market, because here the probability and the expected return over time can be negative. In the stock markets, it's over time positive. Secondly, it's more important to understand that the ranking mechanism, because you have so many tickets to fill, you need to choose how many to fill. And after you're choosing the number of positions, as we can state, you need to know which are the best positions. And now, if we're talking about my strategy, it's kind of a combination of the two. Every single second of trading, my system scans all the universe of my stocks. Okay, I'm not trading all kind of stocks. I'm trading only liquid and big stocks in my universe. So small stocks that have a very low volume, I won't trade. And if it's a small stock with a very high volume, I also won't trade it because it's very volatile. So I prefer to be more conservative. The second thing that is most important is the rebalancing mechanism. My rebalancing mechanism is not fully rebalanced, it's partial rebalance, and I'll explain the difference. Uh, Fully rebalancing,
That's your small trick from the previous research work.
yeah, from the S&P.
What do
So
you mean? What do you mean like half of rebalancing
there
or
is a
near
partial
rebalancing
rebalance and you
mechanism?
have fully rebalance. For example, if stock, for example, let's take NVIDIA. NVIDIA should be 7% of your portfolio. And now it
All right.
raises, and now it's 10% of your portfolio. There is a question, should you put it on 7% again? So you need to sell 3% of it and put in different stocks. Should it be just remain at 10%? Or to go in between, you can put it as a 9%, 8%, 7.5%, 8.5%, because this stock is overperformed this period of time. So it's a question, should you do a full rebalance to put it in 7 or to do partial rebalance? So on my research, I found out that to do fully rebalance, meaning to take the NVIDIA from 10% to 7%, first of all, you're paying the highest fees because you're paying the fees on selling NVIDIA, and then you need to put the money in other stocks. So you pay instead of versus partial rebalance when you're selling just 1.5% or 1% or 2%, you're paying less fees. Moreover, you are losing the momentum because the stock overperformed. You don't want to cut all over performance. You want to cut just part of it. So you can take some, but don't take all the gains to the stock, and you can let it run a little bit more. So the rebalancing mechanism, I understand that partial rebalancing is much better. And I also understand that
Yes, for
cash,
that specific use case.
yeah.
Hmm.
And
Okay.
also that cash is very important because you always have uh, background noises, which can be tariffs that Trump put, or a disaster, or market shock, or you just don't have you can't anticipate it. So when the market goes down, you can find a lot of finding or a lot of good investments during this pressure because you have a lot of overshooting, and then you can buy these findings, and you can also short few stocks. And for that, you need to use margins and cash. And if you don't have cash, you cannot exploit the market when it's most
How much?
vulnerable.
How much? What's the approximate amount of cash that you would need to have, or in terms of margin, in order to execute that type of strategy?
So in my strategy, I'm holding roughly 20% of my AUM is in cash. Most of the time,
Oh,
my average exposure is about 80% to the market. And this has also reduced the volatility dramatically and helps me to create the alpha over time. There are times when my
how much variance
exposure.
do you how much is your alpha how much variance is your alpha having with or correlated with the market regime, or non-correlated at all?
Market regime is also how you define it,
No,
but
not just speaking about market regime itself, but like the current regime, not like not as putting the assumption of actual market regime as market regime detection, but how is your alpha sustainable? Like when we're speaking about the market that you're actually trading, like
so
is it is it
I
is
cannot
it
give you the exact
yeah,
value of
obviously, of
alpha
course.
and the beta and the correlation to the market because it's IP of the fund. But I can let you know that on the last 5 years we saw 2020 with a very deep drawdown, and then 2022 with a very heavy drawdown, a lot of time to overcome it and to rebound back. So if you would see my fund, you can see that the returns are really alternative to these returns. So you can create a very uncorrelated and also alpha in this situation. It's hard to create alpha when the markets are so bullish. For example, 24, 25, it's hard to distinguish if it's a better vehicle or not. During crises or over a period of 3 years, you can see the alpha over time evolve and to be sustainable.
Hmm.
So if we're combining the two research again, we can understand that we need cash, we need to understand rebalancing, we need to understand how to rank the best investment and the worst investment. And now we're talking about correlation that we talked at the beginning. The first position that I'll open in my fund is the best investment in matter of risk adjustment. For example, if we have a
What do you
stock,
mean?
if we have, for example, Google and Nvidia as two stocks, I will see using my forecasting mechanism and by the fundamentals models and the sentiment models and other models that I have, which stock has the best potential, including the risk, to create the best return over time. And why is that? Because there are companies that can create a very high returns in specific periods, but are very sensitive because are losing their um, their monopoly or their edge because they have other competitors. Okay, so the first stock or the first position I will go in is the best adjusted risks, and the
That's
second,
interesting.
yeah, and the second position I'll open in my fund would be in the top. If I'm ranking all my positions from the best one to the worst one, it won't be the second one with the risk return analysis. It will be the second one that is the least correlated to my first investment. And why is that? Because if I want to create a diversified portfolio, I have my best investment and I put my money in that stock or in that commodity or in that uh, instrument. And this is why I'm very satisfied with that investment. And if I'll put money in any other vehicle, I'm kind of taking some of my yield potential or my return potential and put it on a different stock. And I put it
Hmm.
on in a different stock that can create me more stable and more relaxed and more to feel more, how can I say it, reliable, more comfort with my investment. But so
All right.
my second stock, I understand in advance that maybe I'm losing 1 or 2% in my returns, but my risk management is much better. And the third stock I'll choose, or the third instrument that I'll choose in my portfolio, will be the stock with the lowest correlation to the first two stocks that I chose in advance. And this way, I'm building my coalitions until I have 8 different sectors in my portfolio. After having 8 positions, I'll choose my ninth from the beginning. If I choose the vehicles that were ranked 1, 7, 10, and so forth, now I can check the vehicles that ranked number 2, and I can invest in that because, first of all, I have the diversification. I have
Uh-huh.
at
Obviously.
least enough positions to create more, to take more risk. And I can be focused again on the returns more than the risk because I have a risk return adjusted in advance.
But by the way, I wanted to ask you, how do you know how to um how to create the right diversification?
Actually,
Because you assume that the first will be the best risk-adjusted position that you will ever make, and the second will be will be like the continuation, and the third will be the continuation, the fourth and the fifth and the sixth, and continuing on and on and on. And my question is, how do you still making sure to maintain the diversification all around your positions properly, but not just in terms of the universe that you're actually trading, but in terms of the risk adjustments or the risk criteria that you're actually taking, or the bet size. Because when you spoke about the second research about the sports gambling and your inspiration from the sports gambling onto your path as an investor, I was thinking about myself about like statistical methodologies from information theory, like Taylor criterion, or even though binomial trees. How do they work makes the most sense of how you assume that will be going. But a binomial tree, you have like multiple different occasions, and each occasion has its own consequences. So how do you actually make the right diversification in between all the consequences that you're actually creating on with continuing and making more and more positions with time in the market?
first of all, it's a great question. And
Thank you,
for
thank you.
instance, that you can read from
I
that
was
is,
thinking about it. I was thinking about how
yeah.
do you ask the question properly, and I told myself, yeah, let's go, let's rock and roll. That's the
And
best thing.
also, we can ask at the same time, do you prefer that if you're lowering the risk, can you see return over time? Because you're talking only about the risk and not about the return. And we just, for example, if you are very safe and you're creating very diverse portfolio, so what about the returns? And this is the second question that we need to address, I think. So first of all, about the correlation over time, it goes in different paths. In fundamentals and the announcement of the companies, we can see companies that really maybe have different sectors and some do very, 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 very well and some do very bad. So about fundamentals, it's very in one way you can see it, you can say it's very hard to create or test correlation, but in a very perspective way, you can say, okay, we can see a shift in management, see a shift in core business, and then you can create kind of a metrics that can see if there is a correlation or non-correlation in that manner. In time series, we can find a correlation over times and different market regimes. As you said before, you can see how the stocks or sectors perform in this crisis and this crisis, and to understand if the correlation is built or vanish over time. And
Hmm.
also model that monitors the sentiment about stocks and to monitor the volume of them, so you can check the correlation and reassure it every time. At the same time, the correlation is a ratio. You can get it between in absolute return between 0 to 1. So
You know,
it's
you
changing
know,
during time,
uh-huh.
and this is what can create when the covariance matrix is increasing, and you can see the correlation going up. My first and initial response would be to sell some of the stocks and to stay in cash. And this is why I prefer risk
That's
management
interesting.
over building positions over time. And this is if we go back to the gambling mechanism, sometimes you can lose a lot of money. And to lose 50%, it's very easy. But then rebuild the 100% again, it's very hard. And to overcome drawdowns as a fund manager, it's much harder because you have investors that put their faith in you. And this is why 2020 was a great year for me to understand the market regimes and the risk management and why it's so important. Because 2020, when the S&P 500 fell more than 20%, the Nasdaq lost more than 30%. This year was extremely important to understand that risk management is more important than creating a double-digit return every year, because to rebuild yourself, it's much harder than to create more solid returns over time. And this is why we talked about the returns over time. A lot of fund managers using leverage, and then when they saw the throwdowns, they are so heavy and so extreme that they cannot rebuild themselves, and investors withdraw their money, and then they need to shrink their positions. And this is why risk management and rebalancing and saving cash and checking correlation over time and not holding 100% in your positions all the time and saving cash for opportunities is more important over time than being 100% in the market.
Hmm.
So if I'll answer short, the correlation, you can check it on different matrices and you can create your own bar or scale correlations in different models, because my fund has several models in different domains. And if I see that the correlations builds and getting more and more correlated, my first direction would to reduce the number of positions and be more in cash.
Hmm. You know, I have a question about how do you accumulate an understanding of 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 the market based over the several factors that you have spoken about recently, because you've spoken about risk adjustments, risk returns, um, anything that is actually derived out of the stock by definition. So I would ask you, as of your perspective from being a fund manager, how would you actually accumulate an understanding over like taking all those parameters, crafting like a sentiment or a graph or somewhat solution, and to derive the understanding out of it. So that was unclear. How do you look at the current state of your portfolio? How do you actually derive the parameters? How do you actually accumulate into your type of the understanding, and how you draws back the understanding or the insight that you have gathered over the research onto your fund back.
So risk management is it's a big subject, and you can read about it a lot of papers and books and so forth. But actually, the practice is very distinct of that, because to read about it and write about it, it's one thing, and understand risk and manage risk in real time is different. My best advice to all your listeners and viewers is to, first of all, to work in a company that risk management is more important than the returns. And then you understand how big industries or big companies are working, because they're not working to create the one extra percent of return over year. They don't want to lose their market cap and don't want to lose to other risks that has in market, because in market you have always competitors. So if you're working in one company, if you don't have a competitor in the last 2 years, we'll have eventually few more competitors. So you always need to know your surroundings and to understand the risks that you have ahead. If you don't innovation enough, somebody else come and take your spot and so forth. So I worked for the banks for in total 2.5 years, but I then advised to the banks. I was an advisor as 2 more years. So 4.5 years in the banking system make you to understand that most the biggest companies that actually can control the world and give the world cash, there are banks, and their side is to give debt to companies and to retails, and they take risk. The risk is to give somebody money, and they're believing that this person or this company will give it back. And they know that most people will do so, and also most companies will do so. But they will lose money because some of them won't do it. And then you need to be with a rigorous system for risk management. And then you understand in which businesses you have more risk and in which businesses you have less risks, and how that works, and how to understand the natural risk in every and single investment slash debt. And I understand it from debt. I saw so many companies in the bank that took that, and which companies got a problem paying the debt in different situation, under a low rate or high rate of interest rates, and to see different sectoral regimes, that you can see some sectors go up and down, and how tariffs can impact this thing. So it's something that you need to understand and to be very aware all the time. So for me to do so, it's kind of came from my practice, from my experience in the banks and the banking industry. It also was my first understanding in gambling, because doing research on the S&P 500 can be very insightful, but you don't feel the risk. But when you need to gamble money and you can lose all your money in a bet, you're understanding that you need to understand risk over time. And also a tip for your viewers to listen to the news and trying to trading the news. In my understanding, it's not relevant, because most of the information already was in advanced markets, and there are specific things like if we go back to Venezuela, nobody actually knew about it. But for now, we don't see a major shift in the market regimes at all. We can see still everything is green now. Um, but most of the news are non-relevant for trading. The geopolitical movements, the macro analysis, um, the the
Those are the
decisions,
ones who actually
and
make a difference.
yeah, most of them you can see decisions that can make structural shifts, but you can see the process much earlier in the before the information transition to the real outcome. You can see them much ahead. So if you open your eyes and listen, understand macroeconomics, listen to economists over the world, and talking with your analyst friends, you can see a lot of risk all the time, and the last 2 years can make people very positive about markets or very bullish about the market, and forget that there are risks that all the time surrounding us. So we need to be more cautious. And remember, it's money that you gained and saved for over maybe a decade or more. So you need to be responsible with that, because
Obviously,
few bad decisions and you can lose a lot of your money. So
obviously. All right, Oz. Last question that I would like to ask you. In
okay.
terms of you being like you're a hedge fund manager and you're actually looking at the markets right now and you're actually understand the game, like your game in particular, I would ask you how you envision 2026 since we're recording this episode like January 5th. I would like to ask you how would you anticipate from yourself to grow your own fund? Where do you want to go? And what's the criteria that you would have to they would have to step in order to make it happen?
My own goals or the market goals?
Yeah, your own goals, your own goals. I'd like
Okay,
to
so
understand how do you envision the market and how you anticipate it by yourself.
um, about the market, I think then the few more month, I think the next few months, globally, also in Europe and also in the United States, also specifically in Israel, you can see still a very positive returns, because most of the clashes between Trump to Asia and Europe are very is lower the flames, yeah. Where they are searching a kind of a solution so they can all run their administration. Also China and also the United States and also Israel don't have a war. So on the first half of the year, I think we'll be in very positive regimes. I don't know if it's high returns, but positive returns. This is what I believe about my fund. Um, I know the increasement that I have in demand and create in getting inside my fund, but my fund is, as I said and stated before, it's quantitative, so I'm always searching for the edge. So I still have room to new investors, but it's limited. So I hope that everybody that wants to join me can join to my first fund. And I'm working on my second fund that would be more flexible in their investment. And I'm heading to launch it around July or August 2026. And I think this fund will be more multi-strategy, more diverse, and be more competitive at risk situations. For example, if we run again to the administration of Trump, they need to change or to vote about the administration in a few more months. And I don't know what will be in Europe and in Asia, but I think that the second half of the year will be more volatile and we have more surprises. And maybe my second fund would be much better for investors that seek more safety and more stable returns over time.
Amen. All right, Oz. It was a pleasure having you here on over the pod. I can definitely assure and I can definitely say that I was able to learn like multiple things and actually craft like gr great understanding of your research onto my activities that I do in the financial market. So I would like to thank you about that. And thank you for being here. It was a pleasure talking to you.
Thank you. I think it was so so interesting, and the time just flew. It was a very short 1 hour.
Um, um, I will take that as a compliment,
Yeah.
and I'll be extremely and I'm extremely grateful for the opportunity. So you came here and you spent the time together. It was very productive. So thank you for that. All right,
You're
guys,
welcome. Thank
on to
you.
the next time. Thank you.